Hi everyone, I'm delighted to introduce to you Rick Rule from Sprott US Holdings. Rick, welcome to the Financial Fitness Channel.
A pleasure to be with you. Thank you for having me on.
Oh, you are very kind to be here. I would like to start a little bit easy. So what is your investment thesis? Why did you choose the resource sector?
To be honest with you, as a very young man, I chose it because I liked to spend time out of doors. Mining, agriculture, forestry were outdoors. As a consequence of that decision, of course, I've been locked in an office behind a desk for 45 years. But it came about as a consequence of enjoying earth sciences, biology and geology, and my love of the outdoors. Despite the fact that in some senses that was a mistake, I've certainly enjoyed my career ever since.
Okay. And why is it an advantage to include the commodity sector to our portfolios, to really a buy investor? Why would we do that?
I think there are several advantages, frankly, to including commodity-centric investments in a portfolio. The first is that they are relatively simple to understand relative to some other industries. I'm not saying easy, I'm saying relatively easy. I myself grew up in San Jose, California, the heartland of Silicon Valley. And one of the things that I learned knowing technology investors is that many breakthrough technologies become obsolete in 24 to 36 months, which is to say, by the time I understand those industries, they're in fact obsolete. Natural resource industries, by contrast, are much simpler to understand. They are extraordinarily cyclical and they are extraordinarily volatile. So understanding how to make money in commodities over time begins with the simple maxims that in extractive industries, you are either a contrarian, meaning that you buy them out of favor, or you become a victim by buying them when they're too expensive. The separate part of the question is, of course, precious metals, gold and gold stocks. Gold and gold stocks, gold in particular, has traditionally been a hedge against the depreciation of the currency by government action and by the voters. Gold does well when other asset classes do poorly. And gold equities, although they lag gold, in other words, they move after gold, generally magnify the moves that you see in gold. So the gold sector, at least gold itself, you own for insurance purposes, and gold stocks you own for their extraordinary leverage to the gold price.
So you can spice up your portfolio with this sector. Can I say that?
You absolutely can spice up your portfolio, and you can make your portfolio more countercyclical. You can make it more balanced.
Why I did choose it because I looked at in my research what can we expect from the general stock indices in the next 10 years, and it's not a really bright future, because now the level of now it's not cheap. We cannot say that the S&P 500 index is cheap, and that's why in the next 10 years it would be not a nice bet now, at least, because we have to buy really when it's cheap. And yeah, as you say, even if it goes down a little bit, maybe this sector, the resource sector, the commodity sector can a little bit counterbalance that. So that's why I choose that. Am I right? Could it be? Nobody knows it.
No, I don't want to comment on the level of general equities pricing. I'm neither a general market analyst nor am I an economist. When I look at individual stocks in the S&P 500, it is difficult for me as a credit analyst to understand the level of equity valuations in those companies relative to their ability to generate free cash. I'm also cautious because I believe that one of the things that has propelled all equities, including big resource companies hire has been artificially low interest rates. That is, when you have Eurozone bonds selling at negative real interest rates and deposit interest rates at zero, even relatively unattractive dividend yields in stocks become relatively attractive, while at the same time those companies are benefiting from an artificially low cost of capital. I have a real nervousness that if the central governments ever lost control of confidence and interest rates, and market interest rates replaced dictated government-mandated interest rates, that you could see a real sell-off, both in the bond market and the stock market. Don't mistake this for a forecast. I'm not saying it's going to occur, but it's something that certainly scares me.
Yes, it could happen, and I think we live in a world where anything could happen, and we know that at the end of the day, no central bank can be more strong than the market. And relating to that, I get the question often that, for example, silver is also an industrial metal, but why should we buy it now when if a recession comes, then its price will decline? Because the economic activity will decline. What do you think about that?
It's good that you note that silver is both a precious metal and an industrial material. And in fact, the demise of silver as a component in digital imagery, which is to say photography, was one of the reasons why the decline in the silver price was so precipitous. If you look back over time in prior precious metals bull markets, what you see is that the lead metal, the first metal to kick off, is always gold, because it's bought by the fear buyer. It's bought when there isn't a bid for anything else. It takes gold to establish momentum in order for the silver market to move. The silver buyer is both an investor and a greed buyer, a speculator. So when gold establishes the momentum, traditionally silver has moved later, but silver has moved further. The move currently, as you suggest, is complicated because so much demand for silver occurs as a consequence of fabrication applications, particularly these days as a component in solar energy fabrication for solar receivers, and also increasingly for water purification and pollution control. And if, as both you and I suspect, the next 4 or 5 years feature lower than normal or even negative growth, industrial demand for silver could be challenged. What is useful to know about silver in an industrial application is silver's extraordinary utility relative to price. It takes a very small amount of silver, a couple ounces only, to sell a solar panel which might retail for $2,000. That's really worth remembering, because if, particularly with the mandates in place today to employ solar energy around the world, the price of silver becomes almost irrelevant to the demand for silver with regards to solar solar cells, and has very little impact on the finished product price. So it's interesting to know that in silver's primary applications, that its utility to users is so extraordinary relative to its price that there is relative demand inelasticity relative to price. The second thing to remember is that when precious metals run, traditionally they have really, really run. Silver being the poor man's gold means several things. It means that speculators rush to silver as opposed to gold simply because it has more leverage. Sometimes those speculators experience the negative aspects of leverage, of course, on the way down in the market. But the second thing that happens is that because of the low unit cost of silver, It democratizes on a global basis access to the precious metals thesis. Very poor people, particularly in South Asia, in China, Pakistan, Bangladesh, Sri Lanka, might not be able to save in quantities sufficient to hoard gold. Those people hoard in silver because they have thousands of years of experience in the debasement of other mediums of exchange by their government. And in periods of time when precious metals are demonstrating the fact that they're efficacious, when there are stresses in global markets, but particularly stresses in local markets, demand for silver skyrockets.
Yes, and otherwise, just if I look in front of me, I see a camera, laptop, tablet, monitors. So without silver, the whole interview would be not possible. And I like that you don't think that the Western civilization, the way of life as we have it now, goes bust and we will move to the caves, and it is also necessary for the market of resources in general. And I would like to talk a little bit about the earlier topic you mentioned, that this is a highly cyclical sector and one has to be really a contrarian thinker to make money. And I would like to draw the attention to that, and perhaps it is best done through examples. So we saw just what happened a few weeks ago with the oil market. And could you tell us your story, how you made a lot of money? What was your way of thinking then, if you could?
Well, it depends on, and I'm glad you want me to tell a story about making money as opposed to losing money. I can, of course, tell both stories.
Yeah, we'll ask that.
I learned fairly early in my career that markets work in commodities, which is to say that the cure for low prices is low prices, and the cure for high prices is, of course, high prices. It took me probably the first 8 or 9 years of my career to learn that, but I learned it very thoroughly. And what I learned was really when you have a commodity that is essential to our way of living, that is to say, essential to the developed nation's way of life, so that ongoing demand for that product is assured. And simultaneously, you have a circumstance where that commodity is in such oversupply that the selling price for the commodity on world markets is less than the cost of production. You have an industry in liquidation that society can't afford to liquidate, meaning that the price must rise. So in terms of the example that you refer to with regards to the oil market, the International Energy Agency suggests that the fully loaded cost to produce a barrel of oil, and when I say fully loaded, I include prior year write-downs due to malinvestment, I include exploration expense, general and administrative expense, and the cost of capital. That is, it's a truly fully loaded number. The fully loaded number to produce oil worldwide, including inefficient parastatal producers, is somewhere between 50 and 60 US dollars per barrel. So, the industry at present is making the stuff for $50 a barrel, and they're selling the stuff for $30 a barrel, losing $20 a barrel, approximately 90 million times a day. This gets rather boring. Now, Greta notwithstanding, the Greens notwithstanding, oil will continue to be, oil and natural gas will continue to be the preferred forms of transportation fuel, I would suggest for at least 15, but probably 20 more years. The question as to whether the oil price will go up is as simple as asking yourself whether in 5 years or 6 years you go to your garage, unless you have a Tesla, and you turn your key to the right, will your car start or will it not start? If you believe that your car will start, that presupposes that you will have access to gasoline or diesel. And that presupposes that the oil industry can at least earn their cost of capital. And it was that realization going as far back as the early 1990s, when the oil price was about $10 a barrel and the fully loaded cost to produce it was $18 a barrel, that led me to cause my clients to be very overweight oil stocks and oil and gas bonds and participate in that rally. Much more spectacularly, I figured out in 1998 that the most dramatically oversold commodity market I had ever seen, and for that matter, the best contrarian opportunity that I had ever seen, was in uranium. Uranium had been in a 20-year bear market, and investors weren't only bored of it or afraid of it, they had a visceral hatred of it as a consequence of Hiroshima, Nagasaki, Chernobyl, and 3 Mile Island. But the truth was, despite the fact that nobody had made money in uranium, or perhaps because nobody had made money in uranium, and because investors ignored it because they hated it, uranium was selling on global markets for about $8 a pound, at a point in time when the fully loaded cost to produce uranium worldwide was $28 to $30 a pound. Now, we had a massive supply overhang as a consequence of a contest between the United States and the former Soviet Union to fabricate weapons-grade uranium. And in 1999, when we finally came to our senses and began to blend down that weapons-grade uranium to make fuel-grade uranium, the world was tremendously oversupplied. But even during that period of time of oversupply and hate, uranium, as an example, in the United States generated 20% of baseload power. And I knew that over time, either the uranium price went up or the lights went off. I knew, too, that like silver, the finished product from uranium, which is to say electricity from a generator, was so valuable relative to the price of uranium that was required to generate it, that a doubling or tripling or a quadrupling of the price of uranium wouldn't change by even a penny the finished product price of the electricity to the consumer. So I had a commodity where the price had to go up and the price could go up. When you have something that must happen and can happen, you have something that will happen. And that realization, although frankly I was 4 years early, 4 very troubling years, that was the greatest financial event of my career. Coming into that bull market, at the beginning of the bull market, there were only 5 uranium juniors worldwide that had survived the 20-year bear market. The worst of those 5, the worst performing of those 5, in the 5-year uranium bull market that followed, rose by a factor of 22 to 1. The best rose by a factor of 1,000 to 1, not 1,000%, but rather 1,000 to 1. And so that's probably the best contrarian market-related story I have that I have experienced personally.
And the situation today is at least similar, I think, because
the situation in uranium is strangely similar.
Yes, because
it's a little more challenged in the very near term because other forms of electricity are cheap, and because I believe that the economy will be slower for the next 3 or 4 or 5 years than it has been in the last 5 years. So while the price has to go up, it does not have to go up immediately. Remembering, of course, that the last time I was wrong, in the sense that I was 4 years early. I was ultimately extraordinarily right. But people who play the uranium game have to be willing to play the long game.
Yes, and how do you deal with this psychologically yourself, that you are right, but it's not time yet? That's
a very interesting question, or at least interesting to me. it's very odd that now that I'm 67 years old and I have less time left on Earth, and time should be rationally more precious to me, I've become much more patient. I think in 5-year cycles because I've been investing now across 9 5-year cycles. I've been investing for 45 years. And the truth is that I've become oddly more patient even though I have less time to live. Our preference is to be right, and certainly right in the near term. And of course, our preference almost never occurs, sadly. So I think when investors focus, let me kill this, I'm sorry. I think when investors focus on what they can have, as opposed to what they want to have, when investors adjust their own time frames and their own expectations to what is real as opposed to what they want, they suddenly become much more able to adapt themselves psychologically to the time frames and the vagaries of markets.
And this is the experience what you talk about. So that, because you are in this business since a long time, and but it's very, very difficult, and I think maybe it's sometimes it is just better not to make a stupid mistake. Just sit tight. The time will come, right?
Well, certainly Warren Buffett teaches a few lessons, I think, that illustrate this well. One, and this may be less familiar to some European audiences, but one, he suggests that investing is a baseball game with no called strikes, meaning that if the pitcher throws a strike across the plate and you don't swing, the strike isn't counted against you. So he counsels, all you do is wait with your bat, which is your money, until the pitcher gets tired and throws a slow pitch, and then you hit it, going to what you say. The second lesson that Buffett teaches that I think might be instructive to younger investors is he said that markets in the near term are voting machines. They measure emotion. In the long term, they're weighing machines, and they measure value. And it is the delta between the price of something and its value, which is where you make money. The third lesson he teaches, I think, is the most valuable of all, both as a financial tool, but also as a mental discipline. And that is that if you have done enough work on a company to understand something about its value relative to its price, that is, if you understand more than the momentum on a stock chart, if you look at a company as a business and establish a value, you should be delighted if after you buy the stock, within a month, it falls 20 or 30% in price, so that you can double your position with no more outlay of intellectual capital. He said you shouldn't buy a share if you wouldn't be delighted to buy another share 30% less within a month. Most people, if they own stocks and the share price declines, sell them because the only data that they've paid attention to is the price data. They've paid no attention to the value data. Now, ruefully, I must admit I've been tested by this thesis dozens of times in my career, but mostly following that advice, mostly a circumstance where I bought a stock at $10 and saw the stock fall to $7 and had the courage to buy more because I was convinced that my assessment of value was correct. In most circumstances over 40 years, that has been extraordinarily beneficial to me.
That is very well said, I think. And in the meantime, I was thinking that you have something like $10-12 billion under management, right?
I believe that the number today is closer to $13 billion U.S. sprott-wide, although I can't guarantee that number is correct. I can tell you that with the strong market in gold, that net investor inflows into Sprott have been very, very strong.
I'm sure, but something like that. And there's one mistake also what John Bogle said very well, that mutual fund managers, you are not one of them, but they tend to hold most of the cash in stocks when the market is on the high cycle, and then they don't have enough firepower and gunpowder to buy more when the stocks are cheap. And how do you do that? Because then if this market is also cyclical, of course it is, then you have also some periods when you are fully invested and also some periods when you are not fully invested. So how do you deal with that? Shortly.
I have to answer that question two different ways.
Okay.
For myself, personally, I almost always have 20 to 25% in cash and or bullion.
Mm-hmm. Okay.
I believe that having cash is a tool. It gives you the courage and the means to take advantage of volatility rather than being taken advantage of.
Yes.
As a money manager, as an equity manager, managing other people's money and charging them a fee for that, I try to minimize cash during periods of very low interest rates. To the extent that a product that I managed was 25 or 30% in cash as a strategy, and I was charging a management fee, it's very likely that the management fee that I received on those assets would exceed the benefit that the investor was getting, the interest benefit that the investor was getting. So to the extent I can, when I manage other people's money, I ask them to hold a cash balance buffer themselves. I don't charge them a management fee on. There are circumstances in specialized portfolios that I manage where I am over 30% cash now. It's not as a strategy, it's as a consequence of the fact that I haven't found investments in those specialties, special areas that warrant the investment. So this is actually cash that's looking to be deployed, but hasn't been able to be deployed as a consequence of product constraints.
Okay, nice. That's very kind of you and a very nice way of thinking. I would never thought of that. And do you have an offer to our viewers, maybe, when you...
I do.
Okay.
I do. I love circumstances like this. And the consequence of that is that if your viewers will go to a web link, sprotusa.com/rankings. That's SPROTT USA, all one word, /rankings, and enter in the natural resource stocks in their portfolio. I will rank personally those stocks individually and comment on the ones where I believe my comments might have value. In addition, and I'll email that back to the requester, no obligation. In addition, I will include in the return email with the rankings the Barron's Gold Mining Index stock chart. I use the Barron's Index because it's a very broad and inclusive and international index, and also because it goes back 50 years. And that chart illustrates many things: the periodicity and cyclicality of gold, where we are in the gold equities market today relative to other periods in the last 50 years, and the extraordinary upside available in the gold mining index during rallies from oversold bottoms. It's, I would suggest, a must-have visual aid for people who are considering buying gold stocks or people who own gold stocks now. In addition, I'll include a 100-year relative valuation chart on commodities so that people can see just how cheap commodities are relative to other periods of time in the past 100 years. I'm not suggesting that the broad commodities complex is going to rally anytime soon. I suspect that we have to work through a recession that's a consequence of 10 years of economic expansion and the slowdown that occurred as a consequence of the virus. But it's important to know that in real terms, although the commodities market will be challenged on the demand side, that commodities are extraordinarily cheap relative to any levels that we've seen in the last 100 years. So that's my offer.
Yes, thank you. And the market is cheap, but no one said that it have to rise tomorrow. And thank you for the offer. I will put a link below to the description. And I wanted to talk about this now, this offer now, and not at the end of the video, because I have a question to that, relating question. Because I did that exactly what you just offered. I replied to this about a month ago. And you indeed really send me these resources. And when you rank the companies, then what makes them category 1 or 2? So what makes them the best category? None of what, I tell you, none of what I sent to you was category 1 or 2. And I would like to learn a little bit about what makes a company 1 or 2. Are they junior, small, or...
My rankings are extraordinarily harsh, according to other analysts, including other analysts who work for Sprott. So let's get that out of the way first. A 1 ranking for me, by the way, I've given 7 or 8 1 rankings in 30 years of ranking stocks. A 1 ranking, in my opinion, must be selling for less than half of its liquidation value today. I must believe that I could liquidate the company to willing buyers in the industry for twice the share price today after the retirement of all debt. I must believe that if circumstances that are reasonable to assume occur over 5 years, that the stock has 10 to 1 potential. I'm not saying that I believe it's going to rise tenfold in 5 years, but I have to be able to see, using reasonable parameters, the fact that I could get a tenfold increase. There has to be a catalyst in place that I can see that would allow the stock to more than double in 18 months. And the company must be adequately funded to survive the 18 to 24 months that would give me the catalyst. The company must have a tier 1 project, or a project that I believe is reasonably likely to become a tier 1 project. A tier 1 project means that it is large enough to be of interest to a major mining and oil and gas company, that it would be in production in the lowest total cost quartile worldwide, and to be in the best quartile worldwide in terms of return on capital employed. The last number 1 ranking, and the company must also be run by a management team that has a track record of serial success, and that management team must own stock collectively that is worth 5 times their annual salaries. That is, the managers must be partners of mine. They must be owners, not managers. The last number 1 ranking that I gave was in 2017 for Ivanhoe Mines. It was selling at 63 Canadian cents, and it had 97 Canadian cents cash per share in the treasury. In other words, it was selling at a 40% discount to working capital. It had not 1 but 2 tier 1 deposits. One, the Flat Reef in South Africa, a platinum and palladium deposit, and 2, Kamoa-Kakula, a world-scale copper discovery in Congo. The manager, if you will, was Robert Friedland, who I believe has been the most successful mining entrepreneur of my generation. And the identifiable risk was, of course, political risk in South Africa and political risk in Congo. Those risks were partly mitigated because the company's partner in South Africa was an arm of the Japanese government. So you had the ability to have political and diplomatic solutions to political risk in South Africa. And the company's partner in Katanga in China was a parastatal Chinese company, meaning, again, that you had state sponsorship to guard you against some of the political risk, which is, of course, endemic in Congo. So that was the last number one I gave. It's important to note that as of today, and for everyone's records, today is May 20th, I have no 1 or 2 rankings in a universe of 800 stocks that we follow, and I only have 3 rankings.
Yeah, so it is indeed very, very strict, but not impossible when the markets bring that opportunity. Yeah, I like it. I like it. I think I have to watch the time as well and play a little bit safe. And before we say goodbye, would you answer a few questions for my Patreon subscribers?
I would be delighted. Thank you.
Okay, well, thank you. I think I could go on for days. I have so many questions, but we don't have time. And it was for sure very, very helpful for everyone, I think. And thank you very much for your time. If people want to follow you, where can they find you?
The easiest way to follow us is to go to sprottmedia.com, subscribe to Sprott's Thoughts, and go to the Sprott Media YouTube channel. But I would urge everyone to get in touch with us, first of all, in a way that benefits them, which is by sending their natural resource portfolios to sprottusa.com/rankings. In that fashion, I will do something directly for you.
Yes, and thank you for that.
A pleasure.
I think it was a very nice discussion, and thank you again. And I have to say goodbye.
I look forward to a replay whenever you think it's useful to your listeners and subscribers.
Okay, thank you. I think my next question will be, in the future, what can we learn about your mistakes? For sure, everyone made some mistake. What can we learn about that? But it will be the next time.
You better schedule 2 hours for that.
Okay. Thank you. Goodbye.
Okay. Bye-bye.